$737 million. That's what Jeff Bezos just cashed out of Amazon. This isn't a routine sale or a quiet portfolio rebalance. This is the founder making a massive move in a shaky market. When the person who knows the company best takes that much off the table, you have to wonder, what does he see coming? The timing is everything. The market's jittery, Amazon's under pressure, and this sale feels more like a strategic retreat than a planned maneuver. It's not just about Bezos's wealth, it's a signal that every Amazon shareholder needs to pay attention to. Are you more bullish on Amazon than the man who built it? This isn't a panic button, but it's a flashing yellow light. Time to look beyond the headlines and dig into what's really happening. We'll break down the state of Amazon, the economic climate, and what founder stock sales like this have meant in the past. This is about more than one man's fortune. It's about the future of a tech giant and the direction of the market. Don't get mad, get informed. Let's break it down. Context is everything. Bezos' sale didn't happen in a vacuum. It landed in the middle of a storm for Amazon in the US market. Amazon's stock has slid from its pandemic highs, and the company faces market saturation, fierce competition, and a sputtering global economy. Inflation has squeezed consumers, and Amazon's core business is under pressure from unionization and regulatory threats. Bezos isn't selling into strength, he's selling into weakness, and that's what makes this move so significant. The narrative has shifted. Amazon's days of easy growth are over, and every inch of market share is now a battle. This sale pierces the veil of invincibility that surrounded Amazon for years. For a long time, you could buy Amazon and expect to win. Now, you have to be a stock picker, not just a buyer. Bezos' sale is a powerful signal that the risk-reward profile has changed. If it's changed for him, it's changed for you. The era of blind faith in big tech is ending. It's time to weigh the real challenges against future potential. This sale is a wake-up call. Pay attention. Amazon is in a slump, down over 20% from its peak. Investors are rattled, and every negative headline feels like another blow. The core e-commerce engine is sputtering, hit hard by tariffs and a tough supply chain. Higher prices mean lower demand, weaker sales, and a falling stock price, a vicious cycle. Competition is fiercer than ever. Walmart, Target, and niche players are chipping away at Amazon's dominance. Even AWS faces a tougher fight from Microsoft and Google. The once mighty moat is shrinking. Investors see slowing growth, rising costs, and relentless competition. The old growth at any cost story doesn't work when growth is in question. Instead of reassurance, they see Bezos cashing out. It's not a confidence boost, it's a warning. The founder is hedging his bets. That's a tough pill for any Amazon bull to swallow. Yes, Bezos has sold stock before, usually about $1 billion a year to fund Blue Origin. Those sales were regular, predictable, and transparent. But this $737 million sale? It breaks the pattern. It's unscheduled, happening at a time of maximum pessimism for Amazon. Selling into a falling market feels defensive, not strategic. Compare this to Bill Gates or the Google founders, whose sales were part of long-term public plans. This move by Bezos feels reactive and opportunistic, not orderly. Not all insider selling is equal. Context and timing matter. Planned, gradual sales are noise. Big, unexpected sales in weak markets are signals. This is a signal. It's an anomaly, and anomalies demand attention. This isn't just another data point, it could be a turning point. Investors should take notice. Why did Bezos sell? The most bearish answer: he thinks Amazon is overvalued even now. He sees the same headwinds, slowing growth, tariffs, regulation, and may believe there's more pain ahead. As the ultimate insider, his perspective is unmatched. Another theory: he's shifting focus. Bezos is now executive chairman, with interests in Blue Origin, philanthropy, and new ventures. Maybe he sees better opportunities elsewhere. The market's reaction was swift. Amazon stock dipped, and big investors are rethinking their positions. This sale arms bearish analysts and puts bulls on the defensive. The most likely motive? A mixed tough road ahead for Amazon, and more exciting opportunities for his capital elsewhere. For Bezos, holding that $737 million in Amazon stock was no longer the best use of his money. That's the message. Investors should listen. While US tech giants face headwinds, China is rolling out the red carpet for global investors. After years of regulatory crackdowns, Beijing is now offering tax incentives, streamlined business registration, and relaxed ownership rules. China's domestic market is booming, with strong GDP growth in the world's largest, fastest-growing e-commerce sector. Companies like Alibaba and JD.com are leaner and more focused after their own regulatory storms. For global investors, the scale and growth in China are impossible to ignore. The US market is maturing and facing uncertainty, while China is actively courting foreign capital. The risk-reward calculation is shifting. The perceived risks of investing in China are falling, while the potential rewards are rising. Money always seeks the best opportunity. Right now, that path is leading east. Investors are taking notice. The numbers don't lie. Global capital is shifting east. Foreign direct investment in the US is slowing, while China's remains strong, especially in high-tech sectors. Major Western firms are building R&D centers and regional headquarters in China, betting on long-term growth. IPO activity is booming in Shanghai and Hong Kong, while US exchanges are quiet. Chinese tech companies are listing at home, attracting eager investors and high valuations. China's e-commerce market is growing by double digits with innovation in live streaming, social shopping, and logistics. The future of retail is being shaped in Hangzhou and Shenzhen, not just Seattle. Investors are hedging against US uncertainty and seeking opportunity in China's stability and growth. The contrast is stark. The Bezos sale is a microcosm of this larger trend. Capital is de-risking from mature US assets and reallocating to markets with clearer growth. The trail leads to China. So what's the bottom line for you? The Bezos sale is a wake-up call. No stock is a sure thing, not even Amazon. The era of blindly buying big tech may be over. You need to be critical, do your homework, and understand the real challenges these companies face. The easy money has been made. The road ahead for US tech will be tougher. The world is bigger than Wall Street. China's growth story is too big to ignore. Diversification now means looking beyond the US. True global exposure is key. Amazon is at a crossroads and must prove it can find new growth. Bezos' sale puts pressure on leadership to deliver. Stay informed, watch global trends, and consider emerging markets in your portfolio. The game is changing. Old strategies may not work in the new era. The Bezos sale isn't the end, but it's the end of a chapter. How will you position your portfolio for what comes next?